And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And welcome to the show this morning, of course. Happy New Year. And yes, it starts all over again. So here we go. Wishing you all a very happy New Year, and hopefully it'll be a good, prosperous year as we start to move forward. Best news so far, the market return this year, 0. But we did finish up with a 24% gain last year for the S&P 500, 43% for the NASDAQ last year. The Dow was up only 13%. Small cap 600 index up about 14% last year. So good returns for last year across the board, no matter really how you slice it. The S&P had a 15% gain just in the last 2 months of the year. So just, a terrible October, right? Everybody was extremely bearish in October. The bears were definitely growling. And then the market rallies 15% in 2 months and finishes out the year on an up note. So again, very kind of an interesting year when you think back. We had so many different things going on. Think about 2023. You had the banking crisis in March. You had the Speaker of the House getting ousted. You had a debt ceiling debacle going on, right? We were fretting over raising the debt ceiling. Got a debt downgrade from Fitch. All these things that went on, and yet the market returned 24% last year. Here's the important point about this, is that as investors, this is why we always talk about, be careful of these big macro narratives, right? There was so many of these macro narratives last year that we wrote about, we discussed here on the show with you. The threat of de-dollarization, remember that? I mean, it was like, oh, nobody's going to want our currency anymore because of the debt. And we're like, don't buy into that so much. We had rising interest rates. That was supposed to crash the housing market. All these big macro narratives, I'm not saying that these macro narratives never come to fruition, but they typically tend not to be as dire as we tend to think they're going to be. And remember, we talked about right around September, I wrote that article last year talking, showing you the bell curve of potential outcomes and investing on these big kind of the tails. So, worrying about these tails and being all in cash or, whatever it is because of these big tail events that lie really on the outside of possibilities, right? And those are the things that, we focus on. And so last year was a really great indication of that, is that despite all of these big macro narratives that we had going on, markets did okay. Now, it doesn't mean that that's always going to be the case. But this is just why it's so important that as investors, right, our job is to navigate markets and to manage money and to do the best we can. And, this is why it's important to not get sucked into these big macro narratives, good or bad, right? Because they typically never quite turn out the way we expect. Now, so if you're looking for some downside news from last year, well, the return last year, of that 24% return, 75% of that return last year came from multiple expansion, not from earnings growth. So stocks were really bid up last year on expectations of stronger earnings growth, not actual earnings growth. And so there is room this year as we look forward. Expectations for earnings are very high this year. For 2024, we have very high expectations of earnings. In fact, earnings are expected to grow between 11 and 12% this year, which requires that you're going to have fairly substantial economic growth to help support those earnings expectations. And so, there's a risk this year as we move forward that earnings may not be as strong as we expect, and that may mute returns to some degree, right? As valuations have to realign a bit with earnings growth. Now, that doesn't mean the market's going to crash, but it does suggest that some of the exuberance that we saw last year may not carry through the rest of this year unless we happen to get really, really strong earnings growth. Another risk this year as we look forward also is liquidity. Despite, fears of quantitative tightening and higher interest rates, liquidity in markets were actually doing okay last year. We saw bank reserves increase. We saw liquidity in the overall markets increase. We talk about financial conditions ease sharply going through the end of the year. So that's helping support some of that growth from last year. The question is, of course, will we have that kind of liquidity as we move into next year? Okay, there's a lot of things to consider. We'll have lots of stuff to talk about this year, obviously. But here's what you need to know before the bell this morning as we kick off a new year of trading. Yes, returns start at 0 today. So everything as we start to benchmark, right? Benchmark our performance. We do it from January 1st to December 31st. We're starting at 0 today. Terrible way to manage your portfolio, by the way, benchmarking returns. But that's a different conversation for a different day. Here's a couple of things to think about. Now, we had a very, very strong rally into the end of the year. We had 9 straight weeks of advances in the markets. That's a very long stretch historically for markets to have just week after week gains. You're going to have a correction here. We were talking about this over the last couple of weeks of December, saying, hey, markets are very overbought here. Expect a bit of a correction. Now, when that comes, who knows? We're still in the midst of the Santa Claus Rally. Santa Claus Rally is the last 5 days of December, the first 2 days, trading days of January. So today and tomorrow will officially end the Santa Claus Rally. So today and tomorrow, a lot of mutual fund manager, pension funds, etc., putting money to work for the new year. Lots of cash sitting on the books. A couple of things to think about technically, though, as we said, is that markets are very overbought. And so as we kind of think about the market itself and looking kind of at the market dynamics, we had this very, very strong rally from those November lows, from the lows in late October all the way through the end of December. Really not much of a break. And we talked about these buying stampedes previously, is that those can last a while, but you're eventually going to have a reversion of that to some degree. One thing to kind of note here, and again, just as we move into the month of January, if you need to allocate some money, you may just want to kind of wait a little bit here. I think you're going to get a little bit better opportunity, not dramatically so, but a little bit better opportunity to put some money to work. A couple of things that are going on, at least worth considering. Our MACD buy sell signal, which has been a pretty good indicator, is the one that kind of gave us the green light to add money in October, November. Is very overbought here and about to trigger a sell signal. Now, again, that doesn't mean you're going to have a major correction in the markets, but at least you're going to have trouble at this point kind of advancing the markets too much. It doesn't mean markets can't go up, but they're just going to kind of struggle to do so. And we kind of saw that in the last week, as the markets kind of got overbought. That advance that we'd seen previously started to slow down as we got to this really kind of overbought condition. And that's what I mean by limiting upside, is these very overbought conditions kind of limit the ability of the market to move higher. At the same time that we have this kind of overbought condition, we have what's called a negative divergence between the market itself and the relative strength index. The relative strength index has been declining now, even as the market has been going up. That's called a negative divergence, and typically that doesn't last for very long. What this suggests is that you're likely going to get a correction in the markets. In other words, that strength of price momentum is declining. You're about to get a sell signal here, and you've got this kind of upward push in the market. So that typically, those price actions going to kind of give away a bit here to some of the underlying weakness, that there is some selling going on, and that suggests that that's probably going to pick up some traction here over the next week or two. So again, if you were kind of underweight equities last year and you kind of feel a need to get money allocated, be a little bit patient here. I think you'll get a little better opportunity to do that over the course of the next 2, 3, 4 weeks as we kick off this new year of trading. But that's what you need to know before the bell this morning. When we'll come back, we'll talk about the markets, talk about what's going on, some of the bigger picture ideas as we start to kick off this brand new year, and we'll talk about some your New Year's resolutions as well. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Coming up January the 27th, we're having a special event. It's called Navigating the Markets in a Presidential Cycle. Greg Valliere is coming to be the keynote presentation. Adam Taggart will be there. Michael Leibowitz, myself, will be spending the morning talking about the economy, the markets, presidential election cycles, what to expect. Tickets are on sale right now. Early bird registration on the website. If you go to realinvestmentadvice.com realinvestmentadvice.com. Click on the banner at the top. Tickets are $99. We've got very limited seating at Hotel Sonesta here in Houston. You get your early bird special now. Ticket prices will go up as we get into early January. Get your tickets now on the website, realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. So it is, like I said, kind of a brand new year, kicking everything off again for the markets. And, the question becomes, really the question has been really since 2022 is when's the recession coming, right? Is the recession coming anytime soon? And that we've had inverted yield curves, we've had leading economic indicators, we've had this whole kind of variety of stuff going on in the economy, yet no recession so far. And that's been very frustrating. And again, one thing that, we continue to focus back on is this immense amount of liquidity that is still sloshing its way through the system. All that money that was put in from stimulus checks to the Inflation Reduction Act, the CHIPS Act. And, with these acts like the Inflation Reduction Act, which had nothing to do with inflation reduction, it was all about, funding, pet projects, is that it takes time for those projects to get done. So even though the bill was passed a couple of years ago, it takes quite a long time for that money to actually start flowing into the economy because you've got to, find a project, get it approved, go through all the regulatory red tape, et cetera. And it just takes time. This is one thing that Barack Obama learned as president in 2008 when we did the Infrastructure Act in 2008. And, even he said, famously that, shovel-ready jobs weren't quite as shovel-ready as they thought they would be, because it just takes time to get through all the bureaucracy, et cetera. So, all those acts that we passed, all that spending, 1.7 trillion here, 500 billion there, 100 billion over here, it adds up. And all that money has been, starting to come online into these projects, domestic onshoring, et cetera. And that's been fueling capital spending in the economy, which has been supporting things and keeping the economy, keeping people employed and, keeping things going. Real wages as a function are on the rise. Real incomes, ex-government transfers. So once you strip out, the government transfers of disability payments, all those type of things, and you look at just real inflation-adjusted incomes, they've been on the rise. Part of that is due to the fact that we've had fairly strong employment. So again, all that is to say that, no, we haven't had a recession yet. Doesn't mean we can't or won't, but as we were saying at the open of the show this morning, you got to be careful with these big macro narratives that you hear in the media, right? Oh, recession's coming, going to have a recession. We'll know that it's coming, right, when we see one. You'll have evidence that it's coming. And the markets aren't predicting it right now. And, they continue to, money flows continue to support asset prices at this point. Doesn't mean that won't change. But again, this is why we talked about previously, be careful of these big macro narratives. Just, they sound great in theory. And if you hear somebody in the media or on a YouTube channel somewhere or read an article about, this guy definitely going to have a recession in 2024, maybe not. But again, predicting anything in the financial markets longer than about 2 weeks, 3 weeks at the most is very difficult because things change. Markets adapt, people adapt, those type of things. A good example of this is that what you need, right, for a market downturn of significance, right? So now we're talking about 20, if you're expecting this 20, 30% drawdown in the market. Is that possible? Yes, absolutely possible. This market correct 20, 30%, no problem, right? We've got very big deviations from long-term means. We've got, very overbought conditions on a weekly basis, et cetera. So absolutely a 20, 30% drawdown in the market is absolutely possible. What you need is a very unexpected event that changes investors' views about credit, financial stability, etc. Now, here's the funny thing about markets. Everything that you can think of, you're probably in your mind right now ticking off a list of things. Yeah, they got what's going on in Israel. You've got the Ukraine war. You've got a potential war between China and Taiwan. You've got you got the debt issue. You've got the deficit issue. You've got the fact about to have another debt funding thing. We got to come back by January the 19th. We've got a spending deadline that we've got to fund various government programs. All those things are not what are going to hurt the market. Why? Because we know about them, right? The markets already know about those things. So everything you're thinking of right now is stuff that you've read in the media, stuff that you've heard somewhere, you've read something that's talked about this issue. Markets already know about it. If you know about it, the market knows about it. What has got to happen for that 20 to 30% drawdown in the market is for something to occur that the markets were not anticipating at all. And it changes the outlook immediately, not gradually. See, if something happens that's gradual, the markets adapt to it. This is why, when we were talking about last year, there's all this concern over the debt ceiling. Well, if we don't pass this, if we have this debt ceiling and shut down the government, it's going to crash the markets. And we're saying, no, it won't, because payments still get made on mandatory spending and everything continues as normally. And the markets were well aware of all this risk getting built up because it was over a period of a couple of months that we were talking about this. And so the longer that you talk about it, the more the markets adapt to it. And they go, okay, I understand what the risks are, so we're good. What the markets don't adapt for is something that literally changes things overnight, like shutting down the economy. Markets didn't anticipate that. So you had that 35% correction in the markets. The financial crisis. If you go back to 2008, markets were just going through kind of a normal bear market correction until on a Friday, late in the evening, the Treasury, the Fed, etc., all forced Lehman into bankruptcy the next morning. On a Saturday, Lehman's in bankruptcy, and the financial markets are about to go into just chaos because nobody immediately trusts anybody else overnight that anybody's going to be good to meet their debts. So you had a very, very sharp drop. A big chunk of that total decline occurred after Lehman was forced into bankruptcy. Again, an unexpected event. Outside of that, the markets would have had a normal correction, maybe 20%, and we've been over it. So this is why, though, now the Federal Reserve and the government do everything they can not to create situations where they create these unexpected exogenous events. That's what you need for a big market downturn, which means it's not impossible for it to occur. Of course it can occur. The problem is you're not going to know about it until after the fact. But that's what it's going to take. That's what it always takes. It takes these unexpected exogenous events that nobody is anticipating to create sharp market downturns. Long-term capital management, Enron, right? Those type of things. So, again, as we look forward, whatever you're thinking about right now that's in the bearish side of the camp, it's probably not going to happen. What will cause a bearish outcome for the markets is going to be something that we're not even talking about today. Not even thinking about. We already know about China, Taiwan, too. So, if something happens there, it's not going to be the big market shocker because everybody's kind of aware that's eventually going to happen. So it's just a question of how it gets responded to at that point. So something totally unexpected, exogenous event and most importantly, that event has to affect the economic and financial outlook. So when that event happens, it's got to be something that all of a sudden causes the market to go, that is going to impact the ability for companies to grow earnings at the expected rate of return. I now have to reprice lower for that event. That's why it's got to be a credit type event, something that disrupts the credit market, something that disrupts the economic market that will impact the current valuation being assigned to financial markets, and it causes an immediate repricing by markets. That's what causes those crashes. And that's why they occur. And they generally occur over things that nobody ever thought would happen. So whatever you think is going to happen this year, you're wrong. Good or bad. Because it'll change in a heartbeat, whatever it is. Okay, so this is important because, when we come back from the break, we'll talk a little bit about what to expect now as we start the new year, and we'll talk about some investor resolutions. We do this every year just to kind of get you set off on a good step. So when we come back from the break, we'll get into that. But as we think about going forward, right, we have to, shed off the old, right? Whatever happened last year. Let's leave it behind us, and let's look forward to what the new year may potentially look like. Don't go away. Be right back on The Real Investment Show.
Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Coming up January the 27th, we're having a special event. It's called Navigating the Markets in a Presidential Cycle. Greg Valliere is coming to be the keynote presentation. Adam Taggart will be there. Michael Leibowitz, myself, will be spending the morning talking about the economy, the markets, presidential election cycles, what to expect. Tickets are on sale right now. Early bird registration on the website. If you go to realinvestmentadvice.com, click on the banner at the top. Tickets are $99. We've got very limited seating at Hotel Sonesta here in Houston. You get your early bird special now. Ticket prices will go up as we get into early January. Get your tickets now on the website, realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
What is it about teenagers that they cannot keep up with their chargers? I don't get it. I've had the same charger for like 100 years. I had chargers before they were even chargers, and it's the same one.
The Real Investment Show podcast.
Chargers and AirPods, whatever. I'm a Samsung guy. I'm with the other 75% of the population that has a real phone. Truth. Just speak the truth.
Just say it.
At realinvestmentadvice.com.
If you want to know the truth, listen to this show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791, or online at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now, with the new and improved Before the Bell report. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show. By the way, I got lazy over the last week of the year. My wife and I went down to the beach with the dogs for a few days, and I forgot to raise the ticket prices for the event we've got coming up on January the 27th with Greg Valliere, myself, Adam Taggart, Michael Leibowitz, talking about markets, money, investing. I was supposed to raise the ticket prices off our early bird special. I forgot, so I'm going to leave it at the early bird special rate for the rest of this week. We'll raise them next week. So if you haven't gotten your tickets yet, it's January the 27th. It's a Saturday from basically 8 a.m. to noon. We'll feed you, go through a lot of market stuff, lots of presentations, talking about presidential election cycles, outcomes for the year. Greg's an excellent speaker. You will really enjoy the work that he does, especially if you have a political bent. You will enjoy it. He's very good. So if you haven't gotten your tickets yet, do it now. Do it this week because we will raise the ticket prices next week. So again, get by the website, realinvestmentadvice.com. There's a banner at the top talking about the event. So simply just click on that banner. You can get your tickets through PayPal. All the payment instructions are set up for you right there. It's very easy to do. Get your ticket, and then, of course, we'll see you on Saturday the 27th. But take advantage of my mistake and my laziness. It doesn't happen often, but you're going to get a break this week. So be sure and get by the website and do it. So New Year's officially underway. It's hard to believe it's 2024. It seems like it was just 2023 on Friday. Goes by quick. Is your dog afraid of fireworks? No? No. My dog is terrified. One of them doesn't care at all. He's afraid of everything else in the world, doesn't care about fireworks, but my older dog is terrified. So as soon as the first firework goes off, he's like under the bed covers.
Josie is
shaking.
a 5-pound Yorkie that thinks she's a pit bull.
Gotcha.
She did very well because in our neighborhood, it sounded like the Tet Offensive.
Yeah. It's like
Just
Beirut.
ridiculous.
It's like Beirut in my neighborhood.
Yeah.
So, it's worst time of the year, July the 4th and December 31st
Yes.
for Gunner. He just has PTSD the rest of the year. So
Poor dog.
it's all good. Anyway, but it is a new year. So let's talk a little bit about what to expect in the month of January. Historically, January tends to be a very good month. More often than not, if you take a look at January historical returns, there are certainly negative Januaries along the way. Doesn't mean that January is never negative, right? It happens, but it doesn't happen often. And, more often than not, January tends to be a positive month overall. Now, if we take a look, we can break these returns down and kind of look at some different things, and we'll do this in a second. We'll dig into January here a little bit more, but let's talk about this being a presidential election year. So, when we take a look at the, kind of the election cycle, and this is something that Greg will talk about a lot more during his visit on the 27th. But if we take a look at statistics, and these statistics go all the way back to 1833, and we look at each year of the presidential cycle, from the year of election, and then the first year, second year, third year, then back to election. The fourth year of a presidential cycle, the one that we're in now, right, is the best. More often than not, you have an upside to the markets. It's about a 76% win rate in the markets. And the average return runs about, 10% or so, and it tends to be fairly strong. So again, you got the highest win rate of any of the 4-year cycle this year. So odds are that markets tend to do better as we get forward. So, but when we take a look at every month of the year, Brent, skip that chart real quick. Let's move to this. Let's move to this next one. It's just a graphical of a table. When we take a look at the win rate by months, right? So we take a look at each month of the year, and we take a look at the average monthly return and the median monthly return. January has some of the best returns of any month of the year. Again, doesn't mean every year. This is average. This is median over a very long period, right? And so when we take a look at this, specifically and start talking about, the win-loss ratio, et cetera. And again, January has one of the highest win rates of any month of the year. In fact, if we take a look at the number of positive versus negative months, going back over time, January has one of the highest win rates for any month. Now, other months also have high win rates, but January has a very, very high rate of being positive. And there's a lot of reasons for this. And again, as we start off the new year, we're optimistic for the new year. Nothing's happened yet. We haven't blown up anything. Haven't done anything stupid, economically speaking. And so January tends to be positive because we tend to outlook. We want to be positive about the future. So, so we kind of look at these now. January doesn't have the highest return rate of any month. They have a very high win rate, right? But even though January has a very high win rate, its best and worst, if we take a look at the best return for any January, the worst return, it's not one of the highest ones, right? January's best return is 9.2%. Its worst return is 6.8%. And there's certainly other months that have had much higher rates of return. Now, you got to be careful with data. When you go back to 1900, you get some skews to the data. And you take a look at, for instance, August with a 50% return. That was during the Depression. Okay. So you have these kind of skews to the data that occur. And again, this is just looking at the best 1 month return going back to 1900. It can skew that over time. But again, even with those skews, what we know is that the average return over time tends to be positive, again, for the month of January. Now, let's talk about, even though January is positive, we need to talk about how we invest going forward, right? And thinking about all the things. Let's think about last year for a moment. Think about all the things that you did right and wrong last year, right? Were you overly bearish? Were you overly concerned about some economic event or some market event, whatever it was? Or were you too optimistic? And last year was kind of hard to be too optimistic because markets did very well. But think about what worked last year and what didn't work last year, right? This is where we have to do this self-reassessment every year as we start out, learn from our mistakes, learn from what we did right, learn from what we did wrong. And remember that, investor psychology is one of the biggest flaws that we make as investors. And when we think about the issues of returns over time, investor behavior makes up the biggest chunk of why we lose money in the market. So psychological factors. Not having money to invest, not investing money that we have, that's certainly important, right? Not getting capital put to work. But our psychological flaws are what impact our returns the most. And we all have them, right? Last year, we made mistakes last year in our portfolios. There are things that we should have done that we didn't do. There are the things that we didn't do that we should have done because of psychology. Everybody suffers from it, right? There's no perfection in this. What we have to try to do is learn from those mistakes as we move forward and, try to remember that markets move through these fear and greed cycles over time, and those psychological factors over time as we go through everything from optimism and euphoria and exuberance to, discouragement, dismay, and all those type of things. And last year was plenty of reasons to have fear and despair and panic. I mean, there's just tons of reasons to be negative last year. Markets didn't really pay attention to too much of that. But as we think about these cycles, right, we have to remember that those psychological factors are putting us on the wrong side of the trade. One way or the other, being too optimistic or being too pessimistic can work against us over time. So, thinking about, these type of situations, and particularly as we talk about these, this is why as we move into the new year, we have to think about our New Year's resolutions, right? And these resolutions are important because they help us kind of frame our outlook for the year. Now, all these charts and graphs and the resolutions are on the website now at realinvestmentadvice.com. Just click on today's blog post talking about this very thing. But, do more of what's working, less of what isn't, right? So think about what worked last year, do more of that. Think about what you did last year that didn't work and do less of that. Remember that the trend is always your friend. And right now, markets are trending higher. They're not trending lower. And so when the trend changes, you want to become more bearish at that point. But right now, there's very little reason to be bearish because everything is trending positively at the moment. Now, if they're overbought, you're going to have a correction. That's an opportunity to put capital to work. It's okay to be bullish and bearish. There's nothing wrong with that as long as you don't let it drive your investment thesis, right? It's okay to be a little negative on the markets short term, right? Markets are very overbought right now. I'm a little bearish at the moment because I think we'll get a better opportunity to put money back to work. Problem is, as always, is being overly bullish, hoggish, right? Or being super bearish and keeping yourself out of the markets. Those extremes don't work for you as well. We'll come back. We'll finish up with the resolutions and the show right after the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Coming up January the 27th, we're having a special event. It's called Navigating the Markets in a Presidential Cycle. Greg Valliere is coming to be the keynote presentation. Adam Taggart will be there. Michael Leibowitz, myself, will be spending the morning talking about the economy, the markets, presidential election cycles, what to expect. Tickets are on sale right now. Early bird registration on the website. If you go to realinvestmentadvice.com, click on the banner at the top. Tickets are $99. We've got very limited seating at Hotel Sonesta here in Houston. You get your early bird special now. Ticket prices will go up as we get into early January. Get your tickets now on the website, realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
Have the market's gyrations made you nervous? If so, it's because you have more risk in your portfolio than you realize. It's time to reevaluate your long-term investing strategy with RIA Advisors. Our disciplined approach can help eliminate unnecessary risk. We do that by having both a buy and sell discipline. Does your advisor do that? If you think it's time to work with an advisor who puts your interests first, it's time for real investment advice. RIA Advisors, 855-RIA-PLAN, RIAadvisors.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So just kind of going through our January resolutions for the New Year's to, try to be a better investor, right? So our goal is always to improve. And, we're never going to get it perfect. Nobody ever is. Some years are going to be better than others. And sometimes markets do things you don't expect. Last year is a good example of that. So it's always important to review what we did well last year, what we didn't do well on, and certainly made some mistakes last year, me personally, and could have done things better last year that we've got to improve on this year. So it's always important. So we're just kind of going through the resolutions that we review every year, and this is something we always kind of go back to and say, okay, let's review last year, see how we did, and let's talk about the things that we can do better. One of the things that it's always important to remember is that it's okay to pay taxes. Nobody likes to pay taxes, right? But if you're paying taxes, that means you made money. And so you did a good thing, right? So there's ways to mitigate that, do tax loss selling, do other things. But remember, it's okay to pay taxes. Some of the worst mistakes that we make as investors is trying to avoid paying taxes. I should sell that, but I don't want to pay the taxes on it. And then you lose a bunch of money. It's okay to pay taxes. Remember that. Maximize profits by staging buys and working orders and getting the best price. So it doesn't mean you try to actually just pin the bottom, right? So staging a buy is look, I want to buy a company. I want to buy a stock of some sort. So I maybe buy a third of a position. I wait for a pullback to buy a little bit more. And then when it starts going back up, I'll buy some more, right? I stage my buys and I work my price, to build a position over time. I don't have to buy the whole position at one time. There's no law that says that. And an important lesson is to always remember to buy damaged opportunities, not damaged investments. And, this is always one of the problems with value investing. You see a stock that looks really cheap and has good fundamentals, you think, and there's some underlying situation you're not aware of that's plaguing it. There's a damaged investment. Sometimes there are stocks that are just undervalued and they're great companies, and those are opportunities that you should buy. But discerning the difference between a damaged opportunity and damaged investment is very important. Diversification to control risk is important, but this market last year is a good example. Didn't really work well. So it's always important to remember diversification to control management, but also not to impair your performance. Again, emerging markets and international have underperformed since 2008. So diversifying in those markets has not really worked for you as well. It didn't really control risk. It actually added risk to portfolio. So it's important to diversify, but it's also important how you diversify. Control risk by always having stop loss levels and predefined sell levels. So I'm going to buy this company, and if it reaches this price where it's extremely overbought, et cetera, then I'm going to take some profits. It's a challenge to do that because we get greedy when prices are going up and we get fearful when prices are going down. Sometimes, again, if you're staging a buy, you've got to buy a stock, expect it to go down, right? Not panic when it does. Yeah, that's when you have to step in and buy more if you're staging your entry. But, one of the things we do is we tend to panic on the way down and on the way up, and we tend to buy high and sell low for that reason. So try to always control the risk. Do your homework. There was one of the guys I used to work with a long time ago who was very successful, and he was a big golfer. And, he says there's 3 rules to being good at golf. Keep your head down, keep your head down, keep your head down, right? When driving. And his version was a little bit more vulgar, and I can't say it on the radio, but you get the idea. Keep your head down. Same thing with investments. Do your homework, do your homework, do your homework. And, don't take for granted just because you hear it on television or, CNBC or wherever, right? Do your homework. Understand what you're buying. Cash is always king, regardless of what people tell you. Yeah, last year, cash was king at 5%. A lot of people wanted that 5% money market yield. Cash gives you opportunity. There's no problem ever holding cash. But cash is opportunity. It has an opportunity reward. It has an opportunity cost. Hiding in money market last year at 5% sounds great until you realize that the market was up 24% last year. But cash gives you an opportunity, if you have it, to buy something when the market declines or the market gives you an opportunity. So always have cash available to invest. And so if you've got money invested, be saving more money for the next opportunity. And this is why saving money is so important in your overall structure. Don't depend on just, hey, I've got this $100,000 in my bank account I'm going to grow and I'm going to retire on that and I'm never going to contribute to it. Always be adding to it. Always be saving cash. Have cash available to buy opportunity when it comes, because that's the whole point of investing, is to buy an opportunity when it appears. One of the fallacies of buy and hold investing is just, you just buy it and hold it, right? That's not investing. Investing is looking for opportunities that are underpriced that can give you an outsized rate of return over time. That's investing. So cash gives you that opportunity. Don't fear corrections. Corrections are an opportunity. And again, one of the things that we tend to do is we tend to be afraid of corrections. When markets are going down, we go, oh my gosh, they're just going to go down forever. Not necessarily the case. Be flexible. Check hope at the door. Hoping for something to occur isn't a good strategy, right? Build your strategy, work your strategy, follow your discipline. And probably the biggest resolution that will work for you the best is turn off the television, right? Do your homework. Turn off all the noise. Because again, think about last year, right? If you were not in the markets, why weren't you in the market last year? Well, I heard this guy on this YouTube channel, whatever it was, that said the market was going to crash, so I didn't want to do that. So I stayed out of the market last year. Okay. Turn that off. Do your homework, right? Just because somebody says something on some radio show in the morning, as you're driving to work, doesn't mean it's going to happen. And this is why we talk a lot about possibilities and probabilities. And go back to that discussion we had, in September of last year, talking about these tail events. We talk about these things often to try to keep from repeating those mistakes over time. So again, just because somebody says something doesn't mean they're going to be right. So this is why you always want to kind of do your homework. And so, this guy said this, right? So go find somebody that disagrees with him and listen to that argument. And there's one true story, about being bearish. Being bearish is always logical, right? There's always the fundamental facts to back up being bearish. Well, the markets are going to crash because of this reason, the debt, the deficit, interest rates, the Fed. Completely logical. Lots of historical data to support that. But then the market doesn't do what it's supposed to. It misbehaves, right? It goes up when it's supposed to go down. That happens. And that's why we've got to analyze that data, right? And say, this is what's happened historically. We need to be aware of that risk. But markets aren't doing what they're supposed to be doing. They're doing something different. Why are they doing something different? Try to understand that. And look, we were in the camp in 2022. I got to remember what year we're in. In 2022, we said, hey, look, everybody was expecting a recession in 2022. And we said, hey, probably won't have a recession in 2022. Too much liquidity. Probably be 2023. It didn't happen. So we had to adjust for that because as that liquidity kept coming, right, more and more liquidity, the realization that we weren't going to have a recession began to mature. And so we had to adjust for that. So again, it's always important to have a view. You've got to have some view of some sort, right? You can't invest without a view on something, but then be willing, be flexible to adjust that view as you go forward. So, this is, again, all these rules are on the website, these resolutions. I encourage you to go by the website. While you're there, be sure and click that banner at the top of the page and get registered for our event coming up on the 27th. As I said earlier, I forgot to raise the prices, so you get them cheap for the rest of this week. So do it. Get your ticket now, and we'll see you there on the 27th. But the article's on the website now. Hopefully it'll help you a little bit as you start thinking about the new year. As we get ready to open up right now, the futures are pointing lower this morning. And again, not surprising. Market's very overbought, very extended. Wouldn't be surprised to see a little bit of a correction into the first couple of weeks of January. Wouldn't surprise me at all. That'd be a good opportunity to put some capital to work. And we got some new things coming up this year. We're going to be launching a dividend equity model at simplevisor.com this year. So we're kind of waiting for a correction in the markets to do that. So we've had a lot of requests for kind of a dividend yielding portfolio. So we're going to put that together on SimpleVisor for you. And of course, if you have any questions or comments, get by the website. And like I said, get registered for that upcoming event on January 27th. I'd love to meet you if you're going to be there. Love to shake your hand, say hello, and we'll talk about markets, money, and so much more. RealInvestmentAdvice.com. It's all there for you. Thanks for joining us today, and Happy New Year. And we look forward to sharing a prosperous new year with you. Happy New Year, and we'll see you back here tomorrow morning on the next Real Investment Show.